Okay, let us look at some of the differences between NSE and BSE, right? NSE is one of the biggest stock exchange in India, and it is more known for bringing technological advances and introducing the fully automated trading systems. Coming to BSE, BSE is one of the oldest stock exchange in Asia, and one of its advanced feature is its high speed trading, right? And coming to NSE, uh, as electronic trading was incorporated from the beginning of its establishment, that is it was established in 1992. Since then, they are into electronic trading. It has always been a fully electronic stock exchange that promoted paperless trade. Whereas in BSE is much older. So initially, it followed the paper trading pattern. That is since 1875, they were following the paper trading pattern. In 1995, BSE also shifted to electronic trading. Right? Coming to one more difference is the size. The size in terms of the number of companies that are listed. BSE has more than 5,000 companies listed under it, whereas NSE has 1,600 companies listed under it. And the stock exchange of BSE is called as Sensex, which stands for sensitivity index, right? BSE stock index is called as Sensex. It stands for sensitivity index. And this Sensex consists of 30 stocks. NSE stock index is called as Nifty. Nifty stands for National Index of 50 shares. And so it is obviously the index of 50 stock trades, right? Um, Another difference between NSE and BSE is BSE also promotes trading in mutual funds, which you don't see in NSE, right? So these are some of the differences between BSE and NSE. Then apart from this, there are a few more terms related to stock exchanges that we need to know. The first term is the bear market. This is what we are hearing so much at present. At present, India is witnessing a bear market. So bear market is a condition in which the prices of all the securities or shares are falling, and there is a widespread pessimism among the general investors, which causes the negative sentiment to be self-sustaining. Okay, and as investors anticipate losses in a bear market, and as more the selling continues, pessimism also multiplies. So if the market indices fall by more than 20%, then we can say that we have a bear market. So based on this definition, presently Indian stock markets are witnessing a bear market, because if you look at the last 2-3 months, there has been a fall of more than 20%. And what happens in a bear market is prices stay around at the same price, and then they go down along with the indices, and the volumes get stagnant. And in a bear market, it is very difficult to make a quick profit unless and until the seller borrows the stock from someone else and sells the share at a market price, and then repurchases the share and returns them to the owner. Right, so this is one thing. And in a bull market, you would see exactly the opposite of this, right? So the prices of all shares or securities, they are rising, and there is widespread optimism among the general investors. So there is a very positive sentiment among the general investors, and investors keep anticipating more and more profits in a bull market, right? Uh, Prices of some shares go up by 10%, 12%, 15 and 20% also within a span of 4 or 5 trading sessions also. So that is how a bull market And one more thing about bull market is the volumes are very, very high. So you see more and more people jumping into the stock markets during the bull market phase, right? And it is very easy to make profits in a bull market because sometimes the prices of shares increase by 4%, 5%, even 10% on the same day. So, mm, a stock that was bought at 100 rupees during the opening of the tradings at 10 a.m. in the morning, if the same stock price goes to 105, 106, or 107 rupees, they could sell it on the very same day and make profit. So, it is very, very easy to make profits in the bull market. Right? Uh, these are some of the terms that are commonly used in the stock exchanges. Right? Coming to the Indian money market. See, the Indian financial market is huge and it serves as the backbone of the nation's growth and development. While many are familiar with capital markets, which are one of its segments, there is another well functioning arm of the financial market that operates usually in the background, and that is called as the money market. So, though it is not widely recognized by retail, it has a very profound impact on the market participants. Right? Why is the Indian money market so very important? Because of liquidity. See, liquidity is the lifeblood of any business. Manufacturers, especially, they require a steady flow of funds in order to meet their expenditures. And almost all organizations, whether banks, financial institutions, corporates, or even governments, they face challenges with liquidity management at some point of time or the other. And this money market addresses this issue by bridging liquidity gaps. So participants enjoy in short-term borrowing and lending to meet their immediate cash flow needs. This money market is also often referred to as the short-term market because it deals with short-term capital requirements of the businesses and firms. And apart from providing a platform for highly marketable securities, the money market also offers the government a way to finance deficits and to implement monetary policy through open market operations. And it is regulated, the money market is regulated both by RBI as well as the Securities Exchange Board of India. Okay? So the Indian money market can broadly be classified into two categories, the organized sector and the unorganized sector. The organized sector includes the public and the private sector banks, the foreign banks, cooperative banks, financial institutions, insurance companies, mutual funds, primary dealers, NBFCs, that is the non-banking financial companies, corporations, pension funds, payment banks, and small finance banks. And the unorganized sector, it comprises of money lenders, nidhis, chit funds, and other informal financial entities. Coming to these were the participants of the Indian money market. Coming to, let us understand the instruments of the Indian money market. So the instruments that are traded in the Indian money market can further be categorized into two segments, the borrowing and the lending market and the asset market. So the instruments traded in the Indian money market can be categorized into two segments, the borrowing and lending market and the asset market. So the borrowing and lending segment of the money market, it focuses on short-term financial transactions that ensure liquidity within the system. So the key instruments in this segment include call money, notice money, term money, repo, and TREPS. So each of these instruments, they serve a distinct purpose in ensuring the efficient movement of short-term funds between the financial institutions. Coming to the call money market. Call money is an overnight loan that is used by banks in order to meet their daily liquidity needs. So the maturity period is typically 1 day and the banks that need immediate funds borrow from other banks that have surplus cash, and this ensures smooth liquidity in the system. Then this is the call money market. The next one is the notice money market. The notice money market is nothing but an extension of the call money. Here loans are provided for periods ranging from 2 to 14 days. And this type of short-term borrowing is usually done in order to address temporary cash flow mismatches without resorting to any long-term finance. So I need money only for 2 days, for 3 days, for 4 days. So why should I borrow? Why should I even think of long-term financing, which is an unnecessary headache? All right. Then term money market. Term money market, it refers to loans with maturities that exceed 15 days, but less than 1 year. So this term money also again is usually used by banks and financial institutions in order to manage their liquidity for slightly longer periods compared to the call or the notice money. And then you have the repo market, which are repos are nothing but repurchase agreements. They are short-term borrowing instruments that are used by banks and financial institutions in order to raise funds by selling government securities. But there is an agreement here. The agreement is to repurchase them at a specified future date. So the internet on borrowing, whatever interest, okay, on the borrowing, it is included in the repurchase price. So making it a very effective tool for liquidity management. So the maturity period for repos, it can range from overnight up to 1 year. In contrast, a reverse repo is the exact opposite transaction where the central bank or a financial institution lends funds using securities as collateral. So both repos and reverse repos, they are pivotal in maintaining liquidity in the banking system, and they are the key instruments for the RBI to regulate the money supply and manage the systemic liquidity. Repos help maintain liquidity with typical transactions taking place in 1 crore increments. The next instrument in the money market is the tri-party repo. So what is this tri-party repo? Tri-party repo is a type of repurchase agreement where a third-party intermediary, third-party intermediary known as the tri-party agent or the TPA, they facilitate the transaction between the borrower and the lender. The TPA is responsible for crucial aspects of the transaction, including collateral selection, payment, settlement, and custody and management of the collateral throughout the repo period. So this arrangement ensures better collateral management and it reduces the credit and settlement risks. Financial institutions that are widely, most of the financial institutions, they widely use tri-party repos in order to manage their short-term liquidity needs. These agreements typically range from overnight to 1 year in duration. So a key feature of this tri-party repo is its minimum lot size, which is set at rupees 5 lakhs. Like, earlier for repos, we said it is in multiples of 1 crore rupees. So here it is, the minimum lot size is 5 lakhs with borrowing and lending that conducted in the multiples of this amount only, that is multiples of 5 lakhs. So by engaging a TPA or a tri-party agent, institutions can streamline the repo process, ensuring greater transparency, risk mitigation, and efficiency in collateral. Then in a corporate bond repo, a financial institution raises short-term funds by using corporate bonds as collateral. Unlike traditional repos, which typically involve government securities, this type of repo allows for greater flexibility and diversification of the collateral. And the minimum investment amount in this market usually starts at 1 crore, which usually aligns with large-scale institutional transactions only. Right? So in recent developments, the AMC Repo Clearing Limited that has been introduced as a key player in enhancing the transparency and efficiency of corporate bond repo transactions. So establishment of this new clearing house, it facilitates smoother clearing and settlement in the repo market, thus promoting greater stability. AMC repo clearing will provide a central counterparty service, thereby reducing the settlement risk and also ensuring more secure transactions. So this development, it is expected to increase participation in the corporate bond repo market and which benefits both the issuers and investors by enhancing both liquidity and transparency. Coming to money market funds, particularly the liquid funds, they play a very integral role for retail investors and corporations alike. These funds, they address the short-term liquidity needs and they provide easy entry and exit options for those with surplus funds. So money market funds are actually debt mutual fund schemes that invest in short-term, high-quality money market instruments, offering a low-risk, highly liquid option for investors and particularly for emergency savings. So these funds, they provide flexibility for temporary parking of excess funds with easy withdrawal options, making them an efficient tool for managing cash flow. And for corporations, for organizations, money market funds also offer a secure solution for handling working capital needs without compromising on liquidity. Right? Coming to the key trading platforms in the borrowing and the lending market. NDS call, that is negotiated dealing system call. That is an electronic platform for trading in call money, notice money, term money, etc. Now, this NDS call, it enables the banks to trade more efficiently with greater transparency and lower transaction costs. Now, there is another platform called as the CROMS. CROMS stands for Clear Corp Repo Order Matching System. So, this is a platform that is designed to facilitate repo transactions primarily among the institutional participants, such as banks, primary dealers, mutual funds, insurance companies that offer a very robust system that enables real-time matching of repo orders. And another platform is called as the FTRAC. FTRAC stands for Fixed Income Money Market and Derivatives Association Trading, Reporting and Confirmation System. So this FTRAC, it is an electronic platform that is designed for reporting and monitoring trades across the various money market instruments. It enhances transparency and ensures regulatory compliance by facilitating the reporting of repo transactions. It particularly is relevant to those using corporate bonds as collateral. Right? So this system, it helps streamline the reporting process, making it more efficient for market participants. Right? So money market, we said, can be categorized into two markets: the lending and the borrowing market, and then the asset market. So what is the asset market? When it comes to asset market, the instruments included in the asset market are commercial papers, treasury bills, cash management bills, and certificate of deposits. These are some of the instruments. Next, coming to the importance of the money market. See, the RBI leverages the money market to implement its monetary policy by adjusting reserve ratios, by conducting open market operations, and by altering policy rates. It manages systemic liquidity by either injecting funds into the banking system or absorbing excess liquidity to maintain the desired interest rate structure. This ensures that sufficient liquidity is available, preventing banks from borrowing at excessively high rates and avoiding situations where banks face liquidity shortages or hold unnecessary excess liquidity. The RBI conducts daily liquidity adjustment facilities in order to execute its liquidity management strategy by using the or through the banking system. So, this money market has both advantages as well as disadvantages, pros and cons of the money market. So, if you look at the advantages of the money market, the best advantage of the money market is the liquidity management. So, money market, it provides a platform for managing short-term liquidity needs efficiently. That is the biggest advantage of the money market. And then low risk. So most of these money market instruments are always less risky due to their short-term nature. And coming to flexibility, see, uh, money market, it offers great flexibility to organizations, to corporations, to quickly adjust their short-term position based on their cash flow needs, right? So these are some of the biggest advantages of the money market. Coming to the disadvantages, money market also has a few disadvantages. The disadvantages are the returns are low. So because of its short-term nature, the returns tend to be very, very low when compared to long-term investments. And participation is also very limited. The reason the participation is limited is the minimum investment that is required is very, very high. So therefore, the access for retail investors is highly limited in the money market, right? So who should invest in the money market? Who is money market ideal for? The money market is ideal for those investors or those entities that are seeking low risk, short term investment options with high liquidity, right? They don't mind low risk, but they want high liquidity. So it is particularly useful for those institutions that need to, keep their excess funds temporarily, or it is particularly useful for banks to manage their liquidity and for organizations for handling their working capital needs. So, we can conclude by saying that the money market plays a very crucial role in managing the liquidity within the economy. It supports financial institutions, corporations, and the government in meeting their short term funding needs. And with the RBI's active liquidity operations, including the repo transactions, SLF, that is the standing liquidity facilities, the money market ensures efficient flow of funds and it helps maintain economic stability. So platforms like, FTRAC and CROMS, they further enhance transparency and compliance in trading. All these things makes the money market even more resilient, right? So understanding the dynamics of this money market, it empowers the investors and the businesses to make informed decisions, thereby fostering financial stability and growth, right? So if we have to understand the role of RBI in the money market, see, the RBI regulates and oversees the money market. It uses it as a tool to manage liquidity in the financial system, to adjust interest rates, and to transmit its monetary policy effectively, right? So that is about the money market. The next topic that we would discuss is the recent developments in the Indian money market. let us try to understand the recent developments in Indian money market. So the Indian government appointed a committee under the chairmanship of Sukhmoy Chakravarti in 1984 to review the Indian monetary system. Later, Narayanan Bagul Working Group and the Narsimham Committee was also set up. And as per the recommendations of these study groups and with the financial sector reforms initiated in the early 1990s, the government has adopted the following major reforms in the Indian money market. So the reforms made in the Indian money market are the reforms made in the Indian money market are deregulation of the interest rate. So in the recent period, the government has adopted an interest rate policy of liberal nature. It lifted the ceiling rates of the call money market, short-term deposits, bill rediscounting, etc. So the commercial banks are advised to see the interest rate change that takes place within that limit. So there was a further deregulation of interest rates during the economic reforms. And currently, interest rates are determined by the working of the market forces, except for a very few regulations. So that is the first reform. The second one is money market mutual funds. In order to provide additional short-term investment revenue, RBI encouraged and established the money market mutual funds in April 1992. This MMMFs, that is money market mutual funds, they are allowed to sell units to corporates as well as individuals. The upper limit of 50 crore investments has also been lifted. So the financial institutions such as IDBI and UTI, they have actually set up such funds. And the next reform is the establishment of the DFI. So the Discount and Finance House of India was set up in April 1988 to impart liquidity in the money market. It was set up jointly by the RBI, public sector banks, and financial institutions. DFHI has played a very important role in stabilizing the Indian money market. Next, liquidity adjustment facility. So through the liquidity adjustment facility, RBI remains in the money market on a continuous basis through the repo transaction. So this liquidity adjustment facility, it adjusts liquidity in the market through absorption and injection of financial resources or injection of financial, either or, and or either of financial resources. Coming to electronic transactions. So in order to impart transparency and efficiency in the money market transactions, the electronic dealing system has been started. It covers all the deals in the money market and it is very useful for RBI to monitor the money market. This way it becomes easier for RBI to monitor the money market. Then establishment of CCIL, that was also a major reform in the money market. CCIL stands for Clearing Corporation of India Limited. It was set up in April 2001. CCIL clears all transactions in government securities and repos reported on the negotiated dealing system. And then another thing that you see is the government has consistently tried to introduce new short-term investment instruments. For example, treasury bills of various duration, commercial papers, certificates of deposits, MMMFs. These all have been introduced in the Indian money market. So these are some of the recent developments in the Indian money market, right? Next, let us try to understand what is the monetary policy. One second. Right. So what exactly is monetary policy? Monetary policy refers to all those actions um, uh, by the central bank of a country. So in our case, RBI. So monetary policy involves actions by RBI to manage the money supply in the economy, right? So all those actions which RBI takes in order to manage the money supply to promote economic growth and stability, that constitutes the monetary policy. So some of the key strategies that are included are adjusting interest rates and bank reserve requirements, aiming for high employment, and at the same time controlling inflation also. So centrally, most of this apex banks, the central banks like RBI, they primarily use open market operations to influence the money supply and interest rate. So what are open market operations? Open market operations are buying or selling of government securities. Right? So central banks primarily use open market operations to influence the money supply and interest rates. So buying securities increases the money supply and lowers interest rates, encouraging lending, while selling securities decreases the money supply, raises the interest rates, and helps control inflation. Some of the key takeaways from the monetary policy, what are they? They include the first one, interest rates. Right? So the central banks adjust the interest rates to influence spending and investment. Lower interest rates encourage borrowing and economic activity, while higher rates can cool down an overheating economy. Right? And the next one is inflation targeting. Central banks usually have an inflation target that aims for stable prices to maintain the purchasing power of the general public. Right? So they use tools like interest rates and open market operations in order to achieve this target. And then coming to quantitative easing. See, in times of economic crisis, central banks may utilize quantitative easing to inject money into the economy and lower long-term interest rates. And another important takeaway from the monetary policy is forward guidance. So central banks communicate their future policy intentions to give markets predictability and stability. This can influence the market expectations and shape future economic conditions. Monetary policy can impact exchange rates, affecting imports, exports, and overall competitiveness in the global markets. And then these central banks, they sometimes employ unconventional measures such as, negative interest rates, asset purchases in response to unique economic challenges. Next, coming to independence. So central banks are often granted independence to make monetary policy decisions without any political interference. So this ensures credibility and long-term stability of the economy. So, understanding these key takeaways, it is very essential for policymakers, investors, and also the general public to grasp the complexities and implications of monetary policy on the economy. Now, let us try to understand monetary policy in detail. So, the monetary policy involves managing the amount of money in an economy and how new money is created. So, key economic indicators like the GDP, inflation rates, and the growth in different sectors, they play a crucial role in shaping monetary policy strategies. So central banks such as Federal Reserve in the US or RBI in India, they change the interest rates that the banks charge for loans. When these rates fluctuate, banks adjust their lending rates for individuals and businesses. So the central banks may also buy or sell government bonds. They may influence foreign exchange rates, and they may also change the reserve requirements, the cash reserve requirements for the banks. And if we look at the types of monetary policy, there are two types of monetary policy: the contractionary monetary policy and the expansionary monetary policy. So the contraction monetary policy method, it raises interest rates and it restricts the money supply to slow economic growth and lower inflation. It's the primary goal of contractionary monetary policy is to control rising prices that affect purchasing power. And coming to expansionary monetary policy, this approach is used during economic slowdowns or recessions. Interest rate is reduced, and by reducing interest rates, it promotes consumer spending and borrowing, which helps boost economic activity. And some of the objectives of monetary policy are: the first objective is to control inflation. And to control inflation, contractionary monetary policy is applied to lower the money supply in the economy. On the other hand, expansionary monetary policy can lead to higher inflation by increasing the money available. The next objective of the monetary policy is to reduce unemployment. See, the expansionary monetary policy, it helps reduce unemployment by boosting the money supply and offering lower interest rates, which encourages business growth and job creation. Then the exchange rates, right? Monetary policy can influence exchange rates between the local and the foreign currencies. So when the money supply rises, the domestic currency tends to lose value compared to foreign currencies, right? Let us now look at some of the tools of the monetary policy. So the Reserve Bank uses mainly two tools for monetary policy. One is open market operations and the next one is reserve requirements. Okay, open market operations and reserve requirements. Open market operations, they involve buying or selling government bonds to affect the money supply and interest rates. See, what happens when a central bank buys bonds is it adds money to the economy, which lowers the interest rate and encourages lending. On the other hand, when the central bank sells bonds, what it does is it takes money out of circulation, raising the interest rates and also helping to control the inflation. Okay. So the reserve requirements. So the first tool for monetary policy is open market operations, and the second tool is reserve requirements. Reserve requirements are the percentage of deposits that banks must keep as reserves instead of lending out. So if the central banks raise the reserve requirements, banks have very less money to lend, which can slow down the economy and it can help manage the inflation. Similarly, lowering the reserve requirement, it allows banks to lend more and thereby boosting the economic growth. Okay, so monetary policy is vital for influencing the economy and managing the business cycle. By changing important monetary factors, central banks can adapt to economic changes and help maintain financial stability. However, the success of monetary policy can be affected by various elements, like how changes are transmitted, external events, and the central bank's credibility. Next, let us try to understand the difference between the monetary policy and the fiscal policy. So, monetary policy and fiscal policy are two different methods that governments use to affect the economy. Monetary policy is managed by a country's central bank. It focuses on controlling the money supply, interest rates, and credit to meet goals like controlling inflation, encouraging economic growth, and ensuring price stability. The central bank often charges interest rates or conducts open market operations to manage the money supply and borrowing cost. Whereas fiscal policy uh, that is set by the government and involves decisions about spending, taxes, and borrowing. Right? So the goal of the fiscal policy is to influence the economy by changing spending levels and tax rates to stimulate growth, lower unemployment, and stabilize the economy during the downturns. Right? So what are the main differences between monetary and fiscal policy? The first point of difference is authority. Uh, Monetary policy is overseen by the central bank, whereas it is the government that handles the fiscal policy. And the tools that are used that are also different. Monetary policy uses interest rates and open market operations, whereas fiscal policy depends on spending and taxation. Um, then coming to timing, monetary policy can be implemented very quickly, whereas fiscal policy changes usually need legislative approval, and it takes some time to actually implement and enact this monetary policy. Coming to the scope, the monetary policy mainly affects the money supply and financial markets, whereas the fiscal policy directly influences government spending and revenue. So both monetary and fiscal policy, both of them are important for shaping the economy. So policymakers must use these tools very wisely to achieve economic goals and ensure long-term stability and growth. So balancing both policies can help the countries to deal with economic issues and also support sustainable development. Right? So the next thing that we need to understand is the liquidity adjustment facility. So what is liquidity adjustment facility? Liquidity adjustment facility is a tool of the monetary policy that is mainly used by RBI. It enables banks to borrow money through repurchase agreements or lend to the RBI via reverse repo agreements. So this system helps manage liquidity issues and also maintain financial stability in the financial markets. So the RBI